Thank you for tuning in to Primary Source China Investment. This week for show T5, Peng Guo and I are back, and we're talking about China's Lehman moment and why it's not going to happen. And it's also not going to happen for a long-term capital management or an Enron or a Silicon Valley bank. There are two reasons for this, and we're going to get into it right now. Too many market professionals are looking at the Chinese financial system through a US financial system lens. This is profoundly wrong. When you have a financial system that is free to allocate assets without market constraints, you will never have a Lehman moment. In other words, Beijing can pull capital from anywhere to fill a hole. Now, I'm not saying that the US doesn't do this from time to time. Recall the investment in the US auto industry and all the great deals that Jamie Dimon's gotten since 2008 with Bear Stearns and most recently with First Republic Bank. But the acute shocks to the system don't happen in China. Beijing can allocate to unproductive asset classes, and that leads to growth declines like we've been seeing for over a decade in China. It should be noted that China has a lot of tools that they can raise money for. It may not be an efficient allocation of capital, but they can raise money by implementing a property tax, demanding special government shares, so-called golden shares of public companies, or simply assessing massive fines, which they've done in the past. So the first reason we don't see these shocks is because China can pull capital from other areas of the market and fill holes. Peng Guo, what's your thoughts about that?
I think basically, if we are talking about the entire financial market, so beyond that, we have to see who is the decision maker in this country. In the United States, is a capitalist, but in China, capitalist never ever been the decision maker for the country as well as the entire market. It's most likely they follow the policy, they follow the regulation from the power. I think from history always like that. So that really means while managing this market, this area, it's really based on the country interest rather than the capitalist interest to do the work. So while you see it from this angle, you will see the entire market is relatively more stable. And obviously, as a regulator, their core objective is prevent the financial risk for the entire market. They call the systematic risk. I heard this while I started the finance course in the university.
Right.
So they've done a lot of work to do that. Obviously, there's tons of problem in this country, but the overall structure and in a system and different the entire system and the entire country. So they understand. They always you always heard this kind of things.
That's a great point. The second reason there's no Lehman moment is China's growth is a demand export model implemented through a combination of financial incentives, subsidies, lending unconstrained by markets, hard work, innovation, and let's admit it, sometimes IP theft. In the past few weeks, we've heard from the hedge fund managers, Ken Griffin, Ray Dalio, encouraging a return to the good old days with China. Contrast that with CEOs that are tasked with actually making things in China, and the sense is quite different. If you listen to China Beige Book, Leland Miller, and I suggest everybody do that. He's been, reporting on China data for 2 decades. He recently suggested that if Xi Jinping could snap his fingers and create a system independent of the West, he would. Now, we can quibble that this was first brought on by the trade tariffs, but recall that dual circulation came out soon after the trade war started. And if you go further back, there's ample evidence that at the WTO level, China's trade tactics are controversial. There's no doubt that the risk factors have risen in China. So again, the reason we don't see Evergrande collapsing the financial institutions is because, remember, Evergrande went bankrupt in the US. They didn't go bankrupt in China. You had the piecemeal approach whereby these assets were carved up, given to other players in the marketplace so that the volatility doesn't expand throughout other industries and other places in the economy?
I think, yeah, that's right now China is still in the uptrend. So starting from very low base and growth in many different areas. So I think it's in the uptrend, and overall, they still have many growth point in the different area. So like the one companies dig the hole and could shouldn't have a big impact unless even like the evergreen and real estate industry. So they have a lot of the problem and the issues, but the government still take actions to contain the risk just in the company level. So try prevent from spread to entire country level. I think from this point, it's quite successful. So another thing is that in China, you always and people always know who should be responsible for the problem. So like the company get a screw up, dig the hole, and they probably go back to check who should be responsible for that. And obviously, this is all the related actions about
we're also familiar with the Faran, the legal rep of the company, and those individuals are personally liable. So we're familiar with
that's true. So that's really personally you're liable for your mistake.
Yeah,
I think that's a huge difference from Lehman Brothers. So maybe nobody get in the jail or even screw up. This is such a big problem. In China, you already see someone.
Yeah, but there's also a lot of people willing to take that risk in China. Hey, I'm in the far end, but I'm willing to take the risk because the upside is so big. So definitely. And there's people go to jail in China all the time, you know. So yeah, that's very true. People are on the hook personally. The final point I'd like to make is regarding this growth. You know, the allocation of capital in an inefficient way will obviously lead to long-term declines in the growth rate. And we've seen that. We covered that in GDP last week. The question is now, can China sort of flip the switch on the economy and get more and more domestic demand to grow GDP going forward? And that's where we're sitting right now. That's going to be the trick for Beijing, and it's going to be the trick for Chinese companies.
That's true, yeah, and you will see a lot of the policies incentive about the domestic stick the domestic demand. But overall, I think it's still in the business cycle, and no matter what you do, cycle is a cycle. So
yeah, that's a great point, Peng Guo. I mean, too many people. It's like, oh, China bull, China bear. You know, right now it's just like you say, maybe just a soft patch, and you know, maybe just a recession. I mean, it's not a growth recession. I mean, GDP is still growing, albeit slower, but it may just be a recession. And again, like we've covered,
like the cycle perspective is more. And I think it's more reasonable than just collapse or whatever, threaten, just the jump between those 2 points.
Correct. Yeah, it's obviously the nuance is not as interesting, but that's the reality that we're living in. So we're going to leave it this week with show T5. Thanks again for tuning in, and we'll see you next week.
Thank you.